Here is an uncomfortable fact. Most people who lose money in retirement are not victims of some big, dramatic mistake. They are losing it quietly, a few dollars at a time, through things they never think to check. A fee here, a withholding error there. By the end of this video, you will know 7 of these quiet drains, each one backed by an official source you can look up yourself. And number 5 is the one almost nobody checks until it costs them thousands. Let's start with the easiest one to fix, and probably the most common. Recurring charges for things you stopped using years ago. A streaming service you tried once. A magazine app. A warranty plan on a phone you already replaced. This isn't really a retirement mistake specifically. It just gets worse in retirement because income becomes fixed and every unnoticed dollar matters more. The fix takes 15 minutes. Pull up your last 2 bank and credit card statements. Read every line. Not skim read. Anything you don't recognize or don't use, cancel it that day. Here's the takeaway. This is the one mistake on this list that costs you literally nothing to fix, just attention. And yet it's the one most people skip because it feels too small to bother with. But small, repeated monthly for years, is exactly how quiet drains work. Now, the next one is less obvious because it hides inside a system that's supposed to be helping you. Here's something a lot of people don't realize. Social Security does not automatically withhold taxes from your benefit unless you ask for it. According to the Social Security Administration's own publication, withholding income tax from your Social Security benefits, you have to voluntarily request withholding using a form called the W-4V. If you don't, and you owe federal tax on your benefits, you could end up with a surprise bill at tax time, or owe estimated quarterly payments to avoid a penalty. Imagine a retired couple, we'll call them Frank and Linda, who assumed taxes came out automatically, the way they did from a paycheck for 40 years. They didn't. By April, they owed several $1,000s they hadn't planned for. That's not a fee. That's not a scam. That's just a default setting nobody told them about. The fix is simple. Check whether you filed a W-4V and choose a withholding percentage that matches your situation. 7, 10, 12, or 22%. Those are the only options the SSA allows. And by the way, this idea that the system waits for you to act instead of protecting you by default, that theme is going to come back later in this video, in a much bigger way. Keep that in mind for item number 5. Here's one where the government isn't waiting quietly. It's watching. If you have a traditional IRA or a 401k, the IRS requires you to start withdrawing a minimum amount each year once you reach a certain age. This is called a required minimum distribution, or RMD. According to IRS Topic No. 558 on IRS.gov, if you don't take the full amount by the deadline, the missed portion can be hit with an excise tax. The quiet drain here isn't one big penalty. It's the years of people slightly under withdrawing, or forgetting an old 401k from a job they left decades ago, and letting the shortfall pile up unnoticed. The IRS rules changed the required age more than once in recent years. So if you learned the old age from a conversation years ago, it may already be outdated. The only reliable way to know your exact required age and amount is to check IRS.gov directly or ask your account custodian, since the rule applies per account type and can vary. Takeaway: don't rely on memory here. RMD rules have changed. The penalty exists specifically to catch people who forget, and it's entirely avoidable with one calendar reminder a year. Speaking of things that quietly change over time, without anyone telling you directly, that brings us to fees. This one hides in plain sight, on a document you already receive. Investment and retirement accounts often carry ongoing fees, expense ratios, advisory fees, account maintenance charges. Individually, they look tiny. A number like 0.75% doesn't sound alarming, but a fee is not a one-time cost. It's charged year after year, on your entire balance including the growth. Over 20 or 30 years of retirement, a fee that looks small on paper can quietly take a real bite out of what's left for you, simply because it compounds the same way your savings do, just in the other direction. The fix isn't to panic or assume you're being cheated. It's to actually find the number. Look for the words expense ratio or annual fee on your statement, or ask whoever manages the account to state it in plain percentage terms. You have a right to know exactly what you're being charged and for what. Takeaway: know your number. Not knowing it is the actual mistake, not the fee itself. Now here's the one I mentioned earlier. The one almost nobody checks until it's too late. This is the mistake that isn't about money you spend. It's about money that's taken from you quietly over time, without you fully realizing it's happening. According to the Federal Trade Commission's Protecting Older Consumers report, submitted annually to Congress, adults over 60 report significant losses each year to fraud, and the losses tend to be larger per person compared to younger age groups when a scam does succeed. The FTC has flagged this pattern across multiple years of reporting. Here's what makes this a quiet drain rather than a one-time bad decision. Some of these scams aren't a single dramatic phone call. They're a slow relationship. Someone building trust over weeks or months, small requests at first, then larger ones. By the time a family member notices, it isn't one loss, it's a pattern that's been running for a while. The practical fix the FTC and consumer protection agencies consistently recommend, and this is genuinely simple: never make a financial decision under pressure from someone contacting you first, especially if they ask for gift cards, wire transfers, or cryptocurrency. Hang up. Call the agency or company back using a number you find yourself, not one they gave you. Verify independently always. Takeaway: this isn't about being naive. It's about the fact that scams targeting older adults have gotten more patient and more convincing, and the FTC's own reporting confirms the financial impact is real and ongoing. A 30-second pause before acting is often the entire defense. That leads directly into the next mistake, which is about protecting not just yourself, but someone you love. At some point, many of us give someone else access to help manage our finances. A power of attorney, a joint account, a trusted family member added for convenience. The Consumer Financial Protection Bureau publishes a series of guides called Managing Someone Else's Money, specifically because this arrangement, when it isn't set up carefully, becomes one of the quietest ways money disappears. Not through a scam from a stranger, but through confusion or misuse by someone who was trusted with access. The CFPB guidance is specific. It recommends keeping the money of the person receiving help completely separate from the helper's own money, keeping receipts and records of every transaction made on their behalf, and being clear from the start about what the helper is, and is not, allowed to do. The takeaway here is not suspicion of your own family. It's structure. Clear records protect everyone, the person receiving help and the person providing it. Ambiguity is what quietly causes problems, not bad intentions. And that brings us to the final mistake, the one that ties every other item on this list together. Here is the pattern underneath everything we've covered today. Every single mistake on this list: the forgotten subscription, the missing withholding form, the RMD deadline, the buried fee, the scam exposure, the money management arrangement, every one of them is fixable with one habit: a once-a-year review. Not a complicated financial plan, Not a meeting with anyone. Just one afternoon once a year, where you sit down and check in order your bank and card statements for charges you don't recognize, your W-4V withholding status through ssa.gov, your RMD requirement through IRS.gov if you have a retirement account, the fee percentage on any investment account, and whether anyone has requested money from you under pressure in the last 12 months. The mistake most people make isn't any single item on this list. It's assuming these things take care of themselves. They don't. They are designed quietly by default to require you to check. So let's bring it together. Small unnoticed charges add up. Government forms like the W-4V and RMD rules require you to act. They don't act for you. And protection, whether from fees, scams, or unclear money arrangements, comes from records and routine checks, not luck. This is educational content, not financial advice. For anything specific to your situation, the sources named in this video, ssa.gov, IRS.gov, FTC.gov, and Consumer Finance.gov are official places to start, and a licensed professional can help you apply them to your own numbers. Here's a question worth sitting with. Of these 7, which one have you never actually checked? Tell me in the comments, honestly. I'd like to know which of these is the most common blind spot. If you want clear, sourced answers like this every week, with nothing sold to you and nothing dumbed down, consider subscribing to After 60 Compass. We'll see you in the next one.